This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and introduce taxation, look at what taxation actually is, and go through also and start things off, just look at the different types of tax and get used to some different types of tax terminology. Okay, so I think we all know what tax is essentially, isn't it? You have paid tax, I'm sure you will have paid tax, whether that's when you've bought some goods and you've paid sales tax, or whether you've been employed by your employer and you have paid tax on the earnings that you have made. Okay. You are an individual, you may actually own your own company. So again, your company may have paid tax on the profit that it makes. Essentially, what tax is just a contribution. So an amount that is paid by either individuals, businesses, and it contributes there, doesn't it, to state revenue. It's a main way, isn't it, or the main way in which the government can generate money that it can then go through there and spend, can't it, on expenditure. So constructing roads, bridges, hospitals, and be able to develop the infrastructure within the country to hopefully go through there and generate economic benefits into the future. Okay. Again, just bits and pieces just to go through and be aware of. We will talk either about direct or indirect taxes. We will see that a little bit later on. Direct tax is where you pay it directly over to the government. Essentially, there is no intermediary within the process. And indirect tax is whereby you pay somebody else who is then responsible, if you like, for going through there and paying the tax over to the relevant authorities. Okay. Again, bits and pieces just to go through and notes. Tax is used to go through there, isn't it, and influence economic decisions and to promote different values within different countries. Again, different countries have different economies, and therefore tax systems in different countries will be different. So this, if you like, that the way that we get around it is we just look at a general idea of how a very basic tax system should work, and then that will be adapted specifically to whatever jurisdiction that you operate within. Okay. In this exam F1, we're not going to go through there and look at specific jurisdictions and how they operate their tax rules. So we're not going to specifically focus on the UK, the US, China, anywhere like that. We're just going to go through there and look at what a general fair tax system should be. Okay, so all the questions you get, you will be given the specific tax rules within the exam. I think throughout the questions, we talk about country X being a fictitious country that pays 25% tax on its profits. And, we just need to ensure that we know the general principles and how it works. Okay. And those general principles are backed up by a chap called Adam Smith. Okay. And what Adam Smith says about your general principles, if you like, of good taxation. And I think you should go through there essentially and learn these because, it will be a good non-computational aspect, wouldn't it, within any objective test question, asking you what are or what aren't, if you like, good principles of taxation. So first of all, we need to have taxation that has equity within it. So that there essentially is being fair to different individuals. Okay, it doesn't want to put too great a tax burden on those people who are less fortunate and therefore can't afford to pay that amount of tax. So the wealthier you are, the more you are able to pay tax, and therefore you should go through there and pay higher rates of tax. They may disagree with that, but that is then fair, isn't it, to everybody in society. Okay. Also needs to be efficient. By being efficient, it needs to be cheap to administer, so there should be no excess costs. Also, it should be pretty easy, or if you like, simple to go through there to administer with regard to the collection and the timing. Again, I think personally, I think a lot of tax rules within the UK are getting more and more complicated. It is becoming a little bit more difficult to go through there and administer because there are so many detailed tax rules, whether it's on direct or indirect taxes. But I think now the government is understanding that and is trying to make it a little bit more simpler to go through there and follow. Okay. And likewise, as well as being equity and efficient, we also need to consider the economic effects. So that's what we should go through and do there and give regards to different business sectors. In setting the tax rules, we should give consideration to the way businesses operate. So a prime example there would be going through and saying, well, if you're a manufacturing business and you invest in some heavy machinery or invest in some technology, you should be encouraged to invest in machinery, invest in technology. And they encourage that by giving you tax breaks on the money that you have spent. Therefore, what happens is, yes, the business will pay less tax currently, but if the technology works, the business will then generate more profits in the future and therefore will pay more tax in the future as a result of getting those original tax breaks. Okay, so it does tend to go through there and promote investment by businesses when we consider those different business sectors. So that's just a bit of a background in terms of what tax is and what the principles of a good taxation system should be. We can then go through that and start to focus on the two different types of tax, which we have there. Your direct and your indirect taxation. I think we mentioned this very briefly just a moment ago, didn't we? But direct taxes are taxes which fall directly on the person or entity expected to pay it. So therefore, we go through there and you pay it directly over to the tax authorities. Okay, there is no, if you like, intermediary. But your indirect taxes is whereby that is levied on one part of the economy with the intention that it will be passed on to another. So if you go through there and buy goods from a shop or a business, you will be paying sales tax, won't you? You pay that sales tax over to another business. They are responsible for the collection of that sales tax before they go through there and then pay that sales tax on, don't they, to the government. Okay. So your prime example of an indirect tax is sales tax, okay, or in the UK, VAT, value added tax. You've got a couple of examples there of direct taxes, so whereby it falls directly on the business expected to pay it. So tax on your trading income, so your tax by a company is paid based upon your taxable profits, isn't it? Okay, and you prepare that tax computation. We've talked about the accounting for the tax previously, but the tax that is paid directly to the government, isn't it, by the company. Also, as well, we'll touch upon it later on, capital taxes. Again, it is a tax paid, again, like before, by a company, and that's based upon your not just taxable profits, but instead taxable gains. So when you have bought an asset, you have then sold it in the future at above its original cost, you will get a gain, and therefore the government will tax you on that gain and that increase in your wealth. Okay, so they're the two types of taxes, either direct or indirect taxes, and we will begin to look at your indirect and direct taxes in a little bit more detail a little bit later on. Okay, again, I then just find things just get a little bit tedious for a little bit here, so I apologise. But it's just going through there and looking at definitions that you need to know, that you need to learn, and then ultimately be able to go through there and apply. So the first one talks about there is it your taxable person. So that is the person accountable for the payment of tax. Okay. Again, it could be a business, it could be an entity. But if you are generating profits, that company is the taxable person responsible for paying tax. If you go through there and you generate a capital gain, that company again is the person that is responsible for paying the tax. Okay. Other bits that you've got there talks about incidents. Incidents is looking at what's referred to as the distribution of the tax burden. Okay, so we talk about the taxable person being the person who is accountable for the tax, but when we look at incidents, that's looking at who actually pays the tax finally to the government, but also who is responsible, if you like, for the overall tax expense, who bears the cost of paying the tax. Okay, and what you've got there is is it formal incidents and effective incidents. So the distribution of the tax burden is a formal incidence whereby the person or the business has direct contact with the tax authorities. So here, if we're going through and using, so we say sales tax. So we've got the, is it your individual? You've then got the, is it a company? And then what you also have as well, don't we, is the government. Okay. And then when we're going through there and looking at sales tax, aren't we? Remember, the company goes through there and is responsible, isn't it, for collecting the tax. Okay, and that company will go through there, it will collect the tax, and it will pay the tax to the government, won't it? Okay, what you've got there, essentially, that is looking at your formal incidents, okay, whereby your formal incidents is looking at the person or business having direct contact with the tax authorities. If we go through there and look at the effective incidents, that's the person or the business which actually ends up bearing the cost of the tax. So who is ultimately responsible, if you like, for having the burden of the tax expense. And if we're looking at it there, it is the individual, isn't it, who, if you like, bears the tax expense. They actually physically pay. They are the end user of the goods, aren't they? They ultimately pay the overall amount of tax. So what you have there is that here, that's going through there, isn't it? And looking at your effective incidents. Again, it's just terminology. You could get a question, non-computational, that just asks you to go through there and discuss or explain what effective or formal incident is. Okay. As I said, it's not too exciting, is it? But let's carry on. We talked there, is it then about your competent jurisdiction? As we go just ever so slightly too far, apologies. And a competent jurisdiction, it is looking at the authority whose tax laws apply. Okay, so if you're based in the UK and you pay tax in the UK, that's because you are following the UK tax laws, and that is the UK, if you like, it is the competent jurisdiction. Okay, fancy words, I wouldn't worry too much about it at all. Okay. Just two simple examples just to go through there and show you how it all works, in terms of exam questions. These are, I think, if I go back and remember, past old exam questions under the old syllabus where there was some multiple choice. So here it says, which of the following is not one of Adam Smith's characteristics of good tax? So if we go back there, we were thinking, weren't we, about equity, efficiency. One is well, was it going through there and looking at your economic effects, wasn't it? So if we go through there and look at it, equity is a principle of good tax. Efficiency was a principle of good tax, and within efficiency, we said there that needed to be cheap and easy, didn't it? Okay. So essentially, easy is that it should be simple, shouldn't it? Characteristics of good tax, it is not about certainty. Although, tax, like death, it is a certainty in life. It's not one of the principles of good tax, is it? Okay. Example that we've got there underneath, is it there, the one about indirect tax? What is an indirect tax? An indirect tax is a tax that is levied on an individual. Indirect taxes could be levied on individuals or companies, couldn't they? Okay, with our sales tax example that we had before, we said that it was an individual, but ultimately it could be a company, couldn't it? Okay, nothing to say that it has to be an individual. It's based on the earnings of an individual. Well, no, that's more like an employment tax, isn't it? When you earn money from providing your services and then you get taxed by the government. It's paid indirectly to the tax authorities. Sort of sounds correct, doesn't it? But D is the one that matches the definition a bit better, isn't it? Okay, I think C is just a little bit too basic. An indirect tax is levied on one person with the intention that it is passed on to another. Okay, so here with your sales tax, it is levied onto the company, isn't it? Who is then responsible for passing it on to the government. Okay, so again, it's just worthwhile recapping the notes. I think it's probably a good bit of opportunity as well to go through and read the study text on these bits and pieces and practice the questions that they have in there. Because I think here that the only way to get good at it is not just to sit there, look at your notes and read and try and absorb it, but it's to practice the questions, because then you can see where you're going right or where potentially you're going wrong. Okay, so do make sure that you practice these questions to help you with the duller parts of the syllabus. Okay, then what we've got, if we go through and play around with it, is to finish this little bit of the session off. We're going to look at the different types of tax. Okay, we've spoken about, yes, indirect and direct tax, but we're talking here about the application, the principles of how that tax works. Because what you've got there are three different, if you like, principles of tax. Okay. First one that you've got there is referred to as a progressive tax. And this one goes through there and takes an increasing proportion of the income as the income rises. So that's going through there, maybe a little bit like what you have with regards to your payroll and the tax that you pay on your earnings, isn't it? In the UK, we have a lower rate of tax for your lower earnings, and then the more you earn, you will then pay a higher rate of tax. So as your income rises, you will then pay more tax on the amount of income that you generate. Okay. A proportional tax is whereby you take the same portion of income as the income rises. Okay, so it doesn't matter whether you get paid a low wage, a high wage, you'll be subject to exactly the same rate of tax. That, if you like, is very similar to what we have in the UK now with regards to corporation tax. We have a flat rate of corporation tax, so it doesn't matter how big the business is, how large the profits become, you will pay exactly the same rate of corporation tax. Previously, we had different rates of corporation tax depending upon how large the business was. And then what you've got there is a regressive tax, not something that we're used to seeing, maybe because it's not fair. But a regressive tax is whereby you take a decreasing proportion of the income as the income rises. Okay, so as you earn more, you pay less tax. That would be nice, wouldn't it? Okay, but there we go. Wouldn't be too fair and create a balanced society, would it? There we go. So I think the key bit and the key word that you see there is looking at the proportion of the income. And that's what we need to work out within the next example, isn't it? The example goes through there, says what type of tax could this said to be? So it says ABC, XYZ are two businesses that are resident in the same tax jurisdiction. I think that's key because then we're applying the same rules to both companies. And what you see there is that ABC has profits of 45 and a liability of 4,500. And XYZ has higher profits but pays a higher rate or a higher amount of tax. Now, what we need to go through and do there is we need to work out what the rate of tax is to see if it's giving the same proportion, an increasing proportion, or a decreasing proportion. I think you can possibly see it fairly straight away, but let's just check. So what you have there, the proportion of tax that ABC pays, is that taking your 4,500 divided by 45,000. So the proportion of tax to be paid there is 10%, isn't it? Now, if that is then going to be proportional tax, then XYZ would also pay 10%. If it was a regressive tax, as XYZ has made more money, we would pay less tax. I think you can see there that it may be a progressive tax, mightn't it? Because we have generated more income, and I think proportionally we are paying more tax, aren't we? So 8,750 divided by 70,000. Tap that onto your calculator and you get 12.5%, don't we? So we have generated more with regard to your income, and therefore we are paying a higher rate as income rises. So what you have there is that is a progressive tax. Okay, there we go. That's as simple as what it is. If it was to be proportional tax, then on that 70,000 we will pay 10%, so we would be paying 7,000. If it was a regressive tax, then we will be paying less than the 7,000. To make it less than, is it the 10%? Okay, there you go. So that introduces direct taxes, indirect taxes, a couple of definitions that you need to learn in terms of incidence, taxable person, taxable jurisdiction, or competent jurisdiction, I should say, and the different methods, or if you like, the different types of applying taxation in principle. What we'll do in the next session, we'll begin to look at indirect tax before things then get moved on to direct tax.